Good afternoon and welcome to the marketplace. Coming up in this bulletin, July inflation slows further to 12.1%, the lowest since October 2021 and 7 consecutive decline. Also, commercial banks deny creating artificial dollar shortage on the market to cash in on sudden demand by businesses. We are live with the Ghana Association of Banks. We'll bring you details of this and more right after this break. Welcome back to the marketplace. My name is Winston Taki, and our first business story. Inflation rate for the month of July has slowed marginally to hit new record levels. Data released by the Ghana Statistical Service in Accra today showed that it dropped from 13.7% in June to 12.1% for last month. My colleague James Ishan has joined me here in studio to bring us update on what has been the data behind the figures. Now, James, tell us what happened, especially when the government statistician was releasing the data.
Well, so basically, within the last 7 months, what we've witnessed is a downward trend with respect to inflation. When speaking to the government statistician, he made us understand that this is due to general price with respect to food inflation or food price and non-food price. When you go straight to what we have here, that is the data we have in here, it's dropped from 13.7, that was in June last month, to July this month, which is 12.7%. Now, his basic reason for this had to do with marginal reduction in prices of foodstuffs and non-food items. So that's the basics or the basic reason for this particular reduction.
What other factors or figures did come up during the presentation?
Well, so for some of the factors during the presentation had to do with the fact that he was basically raising concerns with the fact that government macroeconomic indicators are positive and hence the need for such reduction. Now, let me take you back to what we have here. This is the 7th consecutive decline in inflation, also the lowest since October 2021. The last inflation, which was some 13.7%, was the lowest since December 2021. But this happened to be that of the October 2021. And this represents 11.7 percentage point drop from December 2024 inflation of, that is 23.8%.
What was the government statistician saying, basically?
So what he's basically saying, I personally posed the question to him with respect to the monetary policy cut that had to do with the 300 basis point cut from 28 to 25. He made mention of the fact that it shows some positive signals out there, but there was a concern though, but which is not really much of a problem. But it appears from what we are seeing, the trend we are seeing going forward shows some positive decline, and that's basically what he's saying.
Great. Before we get to Zoom, let's hear what the statistician said, basically.
Reflect the new regions, the 6 new regions. So in terms of price, we've been able to upgrade the price reference period to 2021, but the weights are still 2017 weights. And as we all know, 2017 is too far from where we are now. Usually, ideally, every 5 years, and even shorter period, you should be able to rebase your CPI to give you more realistic, information on CPI. So we've started the exercise of the rebasing. So it's a good question you ask. We've actually started the exercise. We've gone far. The plan is to ensure that by the end of next year, we would have completed the rebasing. We could even do it way earlier than the year end, but we are looking up to the end of the year to ensure that we do the rebasing. Once we do the rebasing, we'll be able to use a year where prices were stable. So we are currently looking at 2025.
Now let's get on to Zoom and speak to Manager of Macroeconomic Research at GCB Bank PLC, Courage Buti. Courage, welcome to the marketplace. Are you surprised about the drop in inflation, or was it to be expected?
Well, good afternoon to your listeners. No surprises at all. We've been on this bounce for some time now. I think 7 months on the spin. and it's been driven largely by, you could see the food side of inflation, which was the main driver for a long time and still is, but it's been receding and it's been consistent over the last few months or so. We also see the impact of CD appreciation trickling through. And for, if you like June in particular, you saw the significant decline in the CPI for June, which was a marked deviation from the moderate increase you would have expected. That is a reflection of a few things, including base effect and the impact of CD depreciation, CD appreciation, and all that. We've also seen that from where we ended, I mean, maybe the year, we've seen fuel prices also recede from those levels. You are seeing generally a supportive policy environment where fiscal expenditure is largely within check, and we've seen the healthier numbers, how government suppressed expenditure way below what the target is for the period. We've seen also on the monetary side aggressive or more operations to mop up excess liquidity. All of these factors, interventions support the disinflation process, and that is why we expect it to continue despite the maybe simmering pressures that are beginning to emerge from the, if you like, 1 CD per liter fuel price addition, and then of course a few other pressure zones within the inflation basket that simmering. But those in terms of weight and how they would impact the outlook of inflation going forward, I think they are impactors not as pronounced. And so we are all clear to sustain a low inflation maybe regime in the time being.
Great. What do you make of the drivers that were stated during the release?
Oh yeah, broadly aligned, and those are some of the things I talked about. Largely, the main driver has been, if you like, the CD's appreciation, and because the CD's appreciation affects almost everything, the price of imported goods to be affected, how much they clear them at the port to be transmitted into consumers and all that, and the expectation, which is why people price the goods twice or three times the cost they purchase it, because they are preparing for the next import and preparing for the exchange rate dynamics that they may face. With the level of stability we have, it's a bit more predictable issue. You don't see those very sizable pass effect passed down to customers and all that. So those are playing a role. And of course, I've alluded to policy dynamics as well. I mean, the key thing driving inflation, exchange rate, and all that has been the fiscal discipline. And we have seen the impact of what it will be if government remains disciplined. We've seen the controlling of expenditure, the commitment controls and all that, and how it's trickling down into interest rates on the market. It's trickling down into, if you like, other sectors and segments, including exchange rate, and how those are coming together. If we have low cost of credit, it gives you the chance to do structural interventions because real sector players can borrow at cheaper cost to invest and create the goods. So you define inflation as maybe small money chasing or maybe more money chasing few goods. But if we have the resources to produce a lot of goods in the market, then you are solving the demand issues as well, or the supply side issues as well, which are structural in nature. So I think it's all coming together. And now the task is for us to sustain the efforts that will keep inflation low for longer.
You mentioned structural issues being resolved in your analysis. I want to understand from you, considering the fact that we are entering the harvest season, what is your outlook basically going into the third and fourth quarter of the year?
Well, yes, like I mentioned, we've seen a base drop and a significant one at that in June. And largely, you tend to see that in August, September, which is the harvest period where the impact goes in. I do not think there will be very large drops in inflation going forward. There will be marginal going forward because we have kind of exhausted the base effects and all that, I mean, in this period. And so, yes, you would see the impact of food harvest on inflation, but food inflation is already in the recess. And then we have seen a sizable adjustment in the base already. And so going forward, it will continue to go down marginally around the levels we see now, maybe slightly lower than the government target. But then I do not expect very significant declines going forward. in response to maybe food harvest.
Okay, briefly, do you foresee government possibly meeting a single-digit inflation before the close of the year?
Well, it will be a stretch, and there's a reason they keep talking 12 and 11.9 and not, and we can see the month-on-month figures begin to churn out some reversal in trend. It tells you that there are hotspots that need to be looked at. One of them is the fuel side of things that we talked about. Other parts could ultimately also filter through, and we've seen the kind of drivers of inflation, even if they are weight insignificant, things like herrings, things like ginger, and the likes that they mentioned, their weight may not be as significant, but they have some simmering impact in the meantime that will be in the background. So I think from here to end of the year, it will be marginal declines and movement around the levels we have now, maybe not very significant. Yes, we could get to 11 or even slightly lower, but then I do not envisage us getting into single digits for the remainder of the year. That would likely be in 2026.
Thank you very much, Courage Buti, for giving us this insight here on the marketplace. Still speaking on economy, commercial banks have denied that they are deliberately creating a shortage on the market to cash in on surge in dollar demand. It's coming after some businesses and even some members of parliament accuse banks of causing this problem. Let's get on Zoom and speak to the chief executive of the Ghana Association of Banks on these issues. John Ewa joins me now. Welcome to the marketplace. Now, help us understand the situation in terms of dollar supply, because the last time that you were on PM Express, you said you were undertaking some investigation.
Yeah, thank you very much. If you listen to the governor very closely, he actually alluded to the fact that remittance flows had slowed down and that the central bank had undertaken or is undertaking some interventions to mainstream the remittance flows through the banking system so our supply channels will be improved. The last time I spoke to you on PM Express, I mentioned that there was a temporary policy initiative that was implemented sometime around 2023, where the huge supply of dollars that as the banking system ordinarily would have accrued to banks were taken away to the central bank. And that is all export proceeds from the oil sector, export proceeds from the mining sector, and I believe that the telcos as well. These constitute significant component of our export earnings. And those were the flows that banks were using to undertake the interventions that they were doing in the past, very successfully. Now the regime is such that getting access has become very difficult. The main supply source has been the central bank supplying banks through the auction process, and the mechanism for the auction has also changed. Hitherto, it was just an auction. Banks will put in the bids, and the successful banks will be allotted the FX. They will then supply to their customers whose documents they may have in their possession, and they would have vetted the documents themselves, and transaction is done. Now, the central bank is doing pre-audit of the documents. So what it means is that you may be successful at auction, but the pre-audit may take a few more days before the bank will be giving the all clear and the FX released to the banks to undertake the supply. So obviously, these are hiccups within the system that needs some serious attention so we can improve the supply to the market.
There is this assertion that the banks are deliberately holding dollars to create some sort of shortage in the market. What do you say to that?
You see, in periods, if you talked about this in 2023, 2024, perhaps I would have said there may be some element of truth in it because the volatility was very significant. Now, if you are a bank and you keep dollars, I don't know of what use because there is no volatility. So if there is no significant volatility, you are not making any arbitrage, taking arbitrage opportunities. So why would you keep the dollars? You are there to meet the needs and requirements of your customers. So you have dollars locked up in your vault or at the central bank. Your customers are queuing for dollars and you're not releasing them. I cannot understand it. And the only thing I can say is that there will definitely not be any truth to that. If that is the sentiment going on in the market, I am completely debunking that idea that banks are foreign currency and they are refusing to supply to the market.
Finally, we've seen policy rate cut to 25%. Now, certainly the trickle-down effect is to see the banks comply and also cut down their interest rate. Is it currently happening, and which banks do you see they reflecting that in their borrowing cost?
Definitely. The last time I granted interview on your network, I had said that in line with the reduction in the policy rate, lending rate was very likely going to also come down, given the positive correlation between the movement on the policy rate and the Ghana reference rate. So as I speak with you, this morning we have published a new Ghana reference rate, which has now declined from 23.69 to 19.67. That is a steep decline, given that it has almost taken the full load of the 300 basis points that we had on the policy rate. So if you have a facility which is linked to the reference rate, which I guess most of the facilities we have in the system are, then you should see that quantum reduction on your lending rate if you get your next statement.
Thank you very much, Johnny Wah, for giving us this update. We'll certainly be following up in subsequent conversation here on the marketplace. Now, away from that, ARB Apex Bank PLC has maintained a strong financial performance for the 2024 fiscal year, recording a profit before tax of 25.44 million cedis. The bank clocked growth across key indicators, including a 37.3% increase in capital and 83.87% rise in total assets and a 73.66% surge in deposits. This marks a steady recovery from the adverse impact of the domestic debt exchange program that began in 2022. Clinton Yeboah was at the 23rd annual general meeting of the ARB Apex Bank and filed this report.
Sector is bouncing back in the aftermath of an economic downturn experienced in 2022 with the rollout of the domestic debt exchange program under the previous administration. The sector demonstrated significant growth in key financial indicators during 2024. Rural banks made remarkable breakthroughs in digital banking with the adoption of online banking that greatly enhanced convenience and accessibility for rural customers. At the 23rd annual general meeting of the ARB Apex Bank, the manifestation of this growth was tabled for the year 2024. Despite the dynamic and challenging macroeconomic climate, the bank's total assets recorded significant growth of 83.87% from 1.2 billion cedis in 2023 to 2.28 billion cedis in 2024. Chairman of ARB Apex Bank, Daniel Ohenike Owusu, assures that the bank will continue with all efforts to improve quality service, governance, internal controls, and financial performance.
The ARB Apex Bank supported rural banks to operationalize their digital banking platforms. Customers can now perform a host of banking services such as funds withdrawals, funds transfer, bill payments, accessing account statements, and making check requests right from their mobile phones using the special USSD code. The ARB Apex Bank will continue with all the efforts to improve quality service, governance, internal controls, and financial performance. As part of this effort, the bank will not relent on its engagement with the regulator and relevant government officials to address the apparent operational challenges facing the industry.
Investments at the bank increased by 24.38% from 510.1 million cedis in 2023 to 634.5 million cedis in 2024, while loans and advances recorded a higher growth of 104.87%. Managing Director of ARB Apex Bank, Alex Kwesiewa, lauded internal and stakeholder strategies that have secured the bank's elite performance.
Our exceptional financial performance this year as 2024, is a testament to the efficacy of the strategies we have implemented over the past 3 years, marking a significant, consistent improvement in the performance of the bank. This year's performance is following the significant effects of the domestic debt exchange program since 2022. This should provide our esteemed shareholders the comfort as we are now on the brink of achieving greater heights for them. The bank has had to implement some leadership realignments during the year under review because of the strategic importance, imperative, and the utmost intention to achieve the main objectives outlined in the 2022 to 2025 strategic plan.
Clinton Yabo's reports for Joy News.
Is that the Ghana Road Coordinating Council have suspended the 20% expected or projected fare increment earmarked for Friday this month, and that is what has happened now. So there's been an intervention. There will no longer be a 20% increment in transport fares. Thank you for watching today's edition of The Marketplace. My name is Winston Taki. Expect the market beyond the numbers at 2 p.m. Have a good business day. Bye-bye.